table that we are preparing is called, this table is called what? EBIT. This table is called EBIT EPS analysis. What? EBIT EPS analysis, right? And this table starts from where? This table starts from sales, and this is the format need to be followed, right? This is the particular format. We have to follow this format, right? Suppose we have, say we have our turnover 2 lakhs, right? Then we deduct what? According to financial management, we have to deduct first variable cost. First we have to deduct variable cost. Variable costs are the cost which are directly related to, which is directly related to our sales, right? It could be a 60%, 70%, whatever percentage it would be. Suppose this is 50%, variable cost is 50%, that means it is of 1 lakhs, right? Now after deducting variable cost from the sale, the value that will come is called contribution, and this is how much? 1 lakhs, right? Yes, then we have to pay, then we have to minus, then we have to deduct is called fixed cost. Fixed cost is remain same. Fixed cost would remain same without any level of sale. Suppose it is fixed of 20,000. Fixed cost like rent we have to pay. Rent has no relation with the sales or service, right? The value that is come after fixed cost is called EBIT. That was your formula. EBIT, this was that in use in your formula, this one. EBIT in the formula, this was earning before interest and taxes, right? Earning before interest and taxes. So EBIT is how much? 80,000. Getting? Yes, contribution minus fixed cost is called EBIT. Right? Then we deduct what? According to the format, interest. And interest is always calculated on the face value of debenture. Interest is always calculated on the face value of debenture. Suppose we have 1 lakh debenture and its rate of interest is 10%. Rate of interest has no relation with your EBIT, right? Rate of interest or interest amount is not affected with your EBIT. It is a compulsory payment. It is a compulsory payment. So if your debenture is 1 lakh, rate of interest 10%, then you have to pay how much? 10,000 as interest. Clear? Clear? Yes. First contribution, then this is the format we need to follow. First we deduct variable cost, then we deduct fixed cost, then we pay interest, and then after we are going to pay what? Taxes to the government, right? And this is what, after deducting interest from EBIT, this is called EBT, earning before taxes. And this is how much? This is how much? 60,000. Suppose rate of, sorry, it would be 70, no? 70. 80,000 minus 10. Contribution was 1 lakh, then we deducted 20,000 as fixed cost. Amount is 80,000, then we have paid interest on the face value of 1 lakh, right? We are supposing that our debenture amount is 1 lakh. So we have interest paid on the face value 1 lakh. EBT now 70,000. Tax would be a fixed percentage. Tax would be, sorry, earning before tax, earning before interest and tax, earning before interest and tax. Now tax is a fixed percentage. That is, suppose we are paying 50% tax to the government, it means 35,000 we have paid to the government as a taxes, right? Now it become what? Earning after taxes. It is a 35,000. Clear? Now it is your after tax profit. Now you have to pay, preference dividend. Now you have to pay what? Preference dividend. And preference dividend is what? paid to the preference shareholder, not to the equity. Preference shareholder is a kind of liability and its dividend amount is payable every year. Preferential accounts, these are the preference shareholder. If company is declaring dividend, then compulsory to pay preference shareholder dividend, otherwise you have to accumulate it and pay to the next year. It is a compulsory payment. Preference shareholder, I've told you, this is a kind of liability, right? So I am supposing you have 50,000 preference share capital and rate of interest is 10%. I am supposing preference share capital is 50,000 and rate of preference dividend is 10%. Then 5,000 we have to pay as a dividend. Clear? Then 30,000 is become, this is called what? This is become earning available to equity shareholder. This is the amount of owner of the business, earning available to equity shareholder, right? Now you have to find out how many number of share you have in a company. Number of share. Suppose you have 5 lakh share capital, right? You have 5 lakh share capital and each share is of rupees 10. Means face value of share is what? 10. Then you have to divide earning available to equity shareholder by number of share, then you will get the value that is called EPS, earning per share. Earning per share. No, number of share in it is a number of share. Number of share we have calculated is this, like suppose we have 5 lakh share capital. Suppose we have 5 lakh share capital and each is valued at, just a minute. Yes, this is 5 lakh share capital that will be given your balance sheet, and whatever will be the face value, you will divide first by face value, then you will get what is your number of shares. So this is not 10, sorry, I did a mistake. Your number of share would be 50,000. 5 lakh is your share capital amount, 10 is your face value of share. Then what is the number of share? 50,000 is you have total number of share. Then how much would be the EPS? Let's put the formula. EPS would be your earning available to equity shareholder divided by number of shares, right? And this will 0.6. It means you are earning 0.6 per share. Every share you are earning 0.6 rupees. Clear? So suppose you have invested, you have also taken a company share and you have taken suppose 1000 share of a company, right? And suppose company has paid dividend. Now you want to know how much amount you will get as a dividend. So how much amount you will get? Number of share into earning per share rate. Is it EPS, earning per share? You will get 600 rupee. Clear? This sheet is called what? This sheet is called in a finance EBIT EPS analysis, right? This is EBIT EPS analysis. Question start with the sales value and end with the what? EPS. EPS. And this is the example that I have given to you. Suppose you have having 100,000 shares. Now how much amount you will get? You can easily multiply with company's EPS with your own number of share. Clear? Yes. Yes. So we are discussing. It is also numeric. It is also theory question. Normally come to the finance question. Question is why debenture is called tax deductible expense. Tax deductible expense. And this sheet can tell us. This sheet can tell us because more interest we pay, lesser will be the EBT and lesser will be the tax amount. So here is the formula of cost of debt. Finance, how it calculate cost of debt. Now I'm writing the formula. Cost of debt is cost of debt is, cost of debt is not the interest, it is interest bracket 1 minus tax. Now you will be clear. Cost of debt is what? Not interest, interest 1 minus tax. Tax rate, tax rate, you are saying that 10,000 is the interest. Clear? You have told me that, sir, 10,000 is the cost of debt, but I am saying no, 10,000 is not the cost. Actual cost is how much? 10,000 bracket 1 minus tax rate is 0.5. Then actually you have paid how, sorry, actually you have paid how much? Actually you have paid uh yes, 5,000. That's I'm calculating in the Excel. 1 minus 0.5. Why it's not taking? So yes, 5,000. So interest cost of debt formula is what? Interest 1 minus tax. That is the cost of debt. Next concept. Now come to the next concept. What is debt rating? What is the debt rating? These is the debt rating, and these are the company that do. What are the company in India? There are so many companies in India also who are in the rating agencies business, right? Like ICRA we have, right? So many companies we have that provide the rating to the company who issue debentures to the debenture holders, because everyone want to know whether the company will repay our amount, whether the company will continuously pay our interest, whether the company will not involve any fraud. So there are ratings, right? Suppose in the normal scenario, as we that's the banks issue credit card, you must be know it check what? Our credit rating, right? What is the customer credit rating? Whether customer had already involved in some kind of credit card repayment fraud. So companies point of view, market, in the market, there is also concept of what? Credit rating. And rating could be like this: triple A, double A, one, triple B, B, right? And this is the form of credit rating. Triple A means prime maximum safety, means your amount is much safe. Are you getting? If any company is giving, sorry, if any company is getting the triple A ranking, means you must feel free to invest in that debenture, right? Double A means high grade, high quality. A, upper medium grade, and then lower the grade, higher the risk. Clear? Lower the grade, higher the risk. So as an investor, before taking any consultancy, we must read out what? Company's debt rating. Clear? This is the concept of what? Debt rating, and we have also discussed the cost of debt. Clear?